We go, guys. This is a new face. This is not Jason Sipple today, guys. I'm sorry, I'm not as cool and good looking as Jason. He's out with his family doing stuff today, and he asked me to come on here with everyone and share some more information and knowledge about the founding fathers' legacy, about how to become your own bank, how to manage and build wealth, and to share my story. So that's what I'm gonna do today. But I'm pumped to be here with you guys. I see a lot of familiar names in here. Great, guys. Well, I'm pumped to be here with you. Today, I have something a little bit special for you. I'm going to talk about infinite banking, as I'm sure a lot of you guys have heard of or heard Jason talk about. And then I'm going to talk about real estate investing. And that's a lot of what I do. I'm in the real estate space. I've been buying and fixing, flipping homes. I've been doing the Burr method, if you heard of that. I've been lending in real estate, starting a couple funds in the real estate space. And so a lot of real estate is what I've been doing, but doing it and pairing it with infinite banking and with infinite banking policies. And the combo of these two, it just gets ridiculous when you combine them. And so that's what I want to dive into today. And to start, I want to give you guys a little brief introduction around infinite banking so you understand the mind frame that we're in when we're talking about this, and how the whole policy is structured. And then we'll give you some examples of my real estate deals and how you can invest in real estate through your policy. And I want this chat to be super interactive today. There's not a crazy amount of us. There's not thousands of us. And so we can be super intimate. If you guys have special questions or you want me to stop and explain some things, I'd love for you to. So if you have comments or questions, please throw them in the chat and I'll be reading them as I present. So just let me know what your guys' thoughts are with all of this. And if you have more examples you guys want to share, I'd love for you to hop on here and share your screen and I'll make you a panelist and we can talk on here too. So we got plenty of time today. We got the next hour to go over all this stuff. So let me start sharing my screen and we can start getting to it. I know a lot of you have heard of infinite banking, so I'm sure this will not be a surprise to you. So I'll kind of go through this quickly, but I'm going to do a little bit of a spin on infinite banking and talk about it more from the perspective of what whole life insurance is, and less the banking aspect. So maybe this will be new to some of you as well. To start, obviously, we're talking about how to be the bank first, but more importantly, we're going to talk about how this 200-year-old concept has been around and used by the wealthiest families in history to build wealth. And really what they're doing, I'll even skip through this. You guys have seen these examples. You know these people. You know who I am, most of you. I guess I can give you a little heads up. So this is my wife, Anna, and I. We live in Southern California, where we love to surf, travel, be outdoors. We do a lot of fun stuff. But about 3 years ago, I learned about all this money making stuff. I learned about how to make money work for you. I learned about infinite banking. I've been helping people since then on their infinite banking journey. I have built a foundation for myself and my young family to not just be rich, but to build generational wealth. And I can use some of this experience, or I can sum up some of this experience with 2 words, which would be gratitude and choices. I'm so grateful that I get to feel secure and confident in my financial future. But even more importantly, I'm just grateful for the opportunities that I've been given to know of these things at a young age and to be around these amazing people. I'm so grateful for it. And I've had so many mentors in my life guiding me in the right direction to start my career. And second, choices, because I get to choose what I do every day. If I want to go to Europe next month with my wife, I can. I have so much freedom and control over my finances, and that's bled into my personal life. And it's allowed us to do what we want. And my story is pretty simple. I'm probably sure most of you could relate to it too. In my early years, I made a lot of mistakes, as young people do, just figuring things out. But at 18 years old, I did do one thing right. I went on a service trip where I lived abroad and served people for a year. And when I came home, and I was in college, I had a lot of outside influences pushing me different directions. In one hand, I held the traditional route and mindset. I was learning about math, English, economics, and the route of grooming me to be doing good at tasks and being a good employee, essentially. And on the other hand, I held real estate investing, learning about entrepreneurship, freedom, and control. And I came to a point where I had to decide, do I want to work for money, a part of the rat race, or do I want to learn how to make money work for me? And it was that tension of these two things pulling apart that brought me to a point of decision. And that point of decision to drop out of school and pursue an education in investing and start making money work for me, which I like to call the wealth game, completely changed the course of my life. But above all, what's most important is family, obviously. So, you guys in the chat, how many of you guys would like to have enough money to spend as much time with your family as you wanted? Throw I in the chat. I'm sure most of you, right? I always get some that say the opposite. I ask how many of you guys would like to make more money so you could spend less time with your family. There's always a few of those too, but it's really about you and what you want. So I have some ways to get the most out of the meeting today. And I know you want to get the most out of this time too together. So we're going to do some advanced learning techniques. There's a lot of people on here. And so it's hard for me to single you out. So for me to see where you're at and what your thoughts are at every stage of this, I want to see comments. I want to see capital letters, emojis, exclamation points, because it shows enthusiasm. And so let's start by practicing that. How are you guys feeling today? How are you feeling about being here today? Let's throw it in the chat. I want you guys to keep this standard throughout the whole presentation and the whole meeting we have together. I love it. Frank's good. That's all you need, right? I love it. So let's dive into what we're talking about. Let me share. There you go. Could it be possible that there are more efficient ways or environments to store wealth outside of commercial banks that you're not aware of? This is a very important question, and I want you guys to actually think about this for a second. Could it be possible? That should be a yes for most of us. Now, I don't think we'll ever get to a point where we know everything there is to know about money, but this is a powerful question because I want you guys to think about what you're not already thinking about, what you haven't yet been taught. And I hope when it comes to money, we can have a humble learner mentality throughout our life. And I'm sure a lot of you guys have read Rich Dad, Poor Dad or Tony Robbins' book, Money Master the Game. But what are we taught in those books? And really any financial book. Financial 101 is save 10% of your income. That's what everyone talks about. If you can't do that, don't do anything else. Just start with that. I hope most of you guys do that at the bare minimum. But in today's economy, the average American saves about 5% of their income. It's not enough. In our American culture, we don't value savings. We don't value the retention or the retention of our dollars. And one reason that I'm convinced Americans aren't saving enough money is because of the environments or the places that we've been told to store it. These environments like savings accounts, high yield savings accounts, 401ks, some IRAs, mutual funds, they're so incredibly inefficient that it's hard to save money because the money that we place in these environments don't do anything. So what we're going to talk about today is a place you can store your funds that's more efficient. And I like to call it your bank. Your bank is where you're going to start running your income. Instead of running your dollars to someone else's bank that someone else controls, someone else makes money off of, we're going to change that place we're storing our funds, and it's going to be in our own bank, our own spot that we control. So let's start with some attributes of what your bank is compared to a traditional savings account. First off, they're both liquid. Your bank's liquid, and the local, Bank of America or Wells Fargo account you have is also liquid, right? That's great. Now, what if I could tell you that your bank was going to earn 2 to 6% uninterrupted and compounding forever? Your traditional savings account, it's making 0.07%. That's the average savings account in today's market. What if I was to also add to that it was going to grow tax-free? Pretty awesome, right? You're taxed on the tiny percentage of interest you're paid. What if I could tell you it was protected against lawsuits, judgments, liens, market crashing? Your dollars are safe. Whereas in a bank, they're not. And same with stability. In times of economic uncertainty, do you want your money in a Wells Fargo account? Probably not. Besides real estate, which I love, you probably want it in your bank. So let's talk about what your bank is. I like to call it the machine because it's just a machine. Your money's just running through it, and then you're taking it out to go do everything else the same way you are the rest of your life. But I want to start with this quote by Will Rogers. He states, "The problem in America isn't so much what people don't know. It's what people think they know that just ain't so. So the machine we're going to use is what most Americans don't even understand. They think they know, but they don't. We're going to use a specially designed whole life insurance policy, a dividend paying whole life insurance policy from a mutual company. This is the machine we're going to use to run our money through. Now, if you're familiar with the concept, great. But if you're not, don't run away. Don't leave the webinar because you think whole life's a scam. Because you have Dave Ramsey up here saying it is. This is not a regular old whole life. And I'll agree with Dave Ramsey. If he says buy term, invest the difference. Well, if you had a regular whole life and you expect it to do what I'm about to show you, then you're going to be really upset. It's not going to make sense. This is a specially designed whole life policy. So I like to compare this whole life policy to a Ford Focus. How many of you guys go to the Ford Focus or the Ford dealership down the street? You go and see this car and you think, that is the one I want. I mean, some of us, right? But it's not the most beautiful car, but you're at home later, you're on YouTube, and you find a guy named Ken Block. He's riding in his Ford Focus, but this is the Ford Focus he's riding in. And he's going 130 miles an hour around a turn, drifting. And you think that's sweet, right? Well, what's different between that first Ford Focus and this one? Design and engineering. So that's it. We're using whole life, but it's not regular whole life. It is specially designed and whole life, or especially designed and structured to be going 130 miles an hour around a turn. It's going to be like a supercharged bank account more than anything else. So to add to this, let's say that. So to add to this, what are some common sayings around whole life that people have? They say low rate of return, it's expensive, it's the worst investment of all time. If you guys are watching this and you're paying attention, this is your first time learning about this, write this down. Whole life insurance is not an investment. It has nothing to do with investing or investments. This is a control and a banking conversation that I want to have with you. So if you can take anything from today, it's that whole life is not an investment. But when you go home and start talking to your spouse, your neighbor, your business partner, your brother-in-law, and he starts telling you, don't buy whole life. It's a terrible investment. It's got a low rate of return. As soon as you hear someone say that, as soon as you hear someone call whole life an investment, you now know they have no idea what they're talking about because that's not even the right asset type that it is. You cannot get a banking policy from a regular insurance agent or a regular financial advisor. They won't know how to do this. You can only get policies like these from a banking professional, which is what I am and what Jason is and what we teach. So when we're talking about how to be like the bank, like the wealthy individuals, we just have to mimic what they do. And so what do the banks do? If you look this up, BOLI, B-O-L-I, if you Google it, it stands for bank-owned life insurance. You will find that banks own more whole life insurance than they own in land and buildings combined. They don't own IULs. They don't own term insurance. They own more whole life. And banks are actually the number one purchasers of whole life insurance in the world. And not only do they own more life insurance, they keep buying more every year. So are banks stupid, or do they know something we don't know? Between these four banks, they own over $60 billion in whole life. Guys, they're not stupid. They're smarter than I am, smarter than you are. We just need to mimic them. Do you know what else banks and wealthy individuals all own? Real estate. Why? Well, this is why. There you go. The four pillars of investing, I like to call it. So if you were to go deposit money in a stock market account, a mutual fund, what are you going to get? You're going to get appreciation. You're going to get the stock you bought is going to increase in value. You're going to have a larger dollar amount. It's just gaining appreciation. The four pillars of real estate investing. This is why I like to invest in real estate versus any other investment. I could care less about the stock market or a 401k or even crypto because it doesn't have these four things. I'm only going to invest in what has these four things: appreciation, tax benefits, leverage, and cash flow. Here's what I mean. You own a piece of property, you own a rental. Historically, it's going to appreciate, right? Over a 5-10 year period, it's going to increase in value. So that's great, right? You get the appreciation. Now, beyond that, what else do you get? Great, it has appreciation. Your home's going to increase in value. Awesome, just like the stock market. But you buy a rental property, you could do cost segregation studies. You can write off interest payments. You can write off expenses. There's tax benefits. Now there's more than just appreciation. And what do you get after that? You get leverage. Why is leverage important? Well, if I go put a 20% down on my house or on a rental and I get the rest paid for by the bank, let's say the home's $100,000, I put $20,000 down. My 20 grand just turned into $100,000. Just like that. $100,000 asset I own with $20,000. And if I have a tenant in there paying for it, they're just paying down the loan. It's free money. Debt is the asset for me. I just leveraged it. My 20K, it became $100,000 immediately. And over time, someone else is going to pay that off for me. So I get leverage and I get cash flow. You get monthly rental income. So not only do you only get appreciation, but only appreciation like crypto or like the stock market, you get all these other added benefits. You don't get to write off a stock market purchase. You don't get to leverage investing in the S&P. This is why real estate's the best asset to invest in. Personally, it's what I think. And you can do this with a single family home. All these big investors, they're talking about buying commercial properties, land, apartments. That's great, but it's the same thing as buying a simple single family home. You don't need $1 million to do real estate. I have a buddy who's been buying rental properties in Indiana, and he says the homes are $45,000. You only need $8,000 to close on a loan like that. You know how many rentals in Indiana you could buy every single year if you just saved up that amount of money and rented into rental properties? So many. You don't need a large lump of money to get into real estate. You can use the bank to leverage it. You can use a tenant to pay it for you. You can get a property manager to manage it for you, so you never even have to look at it. I've never been to any of my rental properties, and I own 45. Not one. I have someone else managing it, someone else living in it, someone else paying down the debt. The entire time, I get to take the cash flow, I get the tax write-offs, I get the appreciation. And yes, real estate is not 100% passive. There's active work that's involved. Sometimes I get a call from my property manager that they have to fix the toilet. Great. I send them a check, they fix the toilet. It takes 10 minutes of my time. Real estate can be passive. Real estate can be easy. You just have to have the right crew around you. But I'm willing to even have, if it was more work, I have a good system now. But if I didn't, and I was managing every property, I was walking to the houses, fixing things up every day for tenants, it still has those 4 investment aspects, those 4 pillars of investing, and the stock market doesn't. So I'd still rather do that. So real estate is phenomenal. Now, how are we going to pair real estate with IBC? Well, actually, I should share this with you. Let me pull this up. I was going through this with someone today, and this is a great example. This is my personal situation with my entity setup. I'm showing you this because I want to give you guys an example of how money can move to go buy real estate. So I have an active side of making money and a passive side of making money. They're separate. I have an active holding company and a passive holding company. I have an insurance business, sells life insurance and teaches banking. I have a consulting business. I have my wife owns a hair business. We have a real estate investing, active flipping business. All of these businesses create income. Where does my income go? Flows, this is a bad drawing, flows to my holding company. Every month, all my extra income flows into here, okay? Once it's in my S Corp and my holding company, now to the IRS, I am a business consultant. I own a holding company that manages other businesses. That's my profession to the IRS, which means I get any expense I have that helps me as a business consultant, I can write off. All right, so that's great. I get all my expenses my income coming here, expenses coming out, and then everything left over gets paid to me in a W-2 or a distribution. Now, what do I do with all my income? I'm trying to go run it into real estate, all of it. So what's the most efficient way for me to do that? Well, I want to use it and run it through my policy, because remember, my policy is the best savings liquid environment. It's going to be liquid. Going to be guaranteed to increase in value. It's protected. It has a death benefit. So now all I have to do is run my income, all my extra income to go into investments, into my bank, my policy. It's going to go sit into here, my policy. And then when I have enough or I'm ready to go buy rentals or the deal comes around, boop, shoot over to my holding company, go buy rental, comes back in here, goes buy a rental. More income comes in, another rental. This is what I'm doing, is I'm running all my dollars through a policy because this is the best savings vehicle. And then when the time's right, I go buy rental properties. Let me know in the chat if this is making sense. If you want me to hit this specific topic more, if you want me to hit this less and go back into more of the policy stuff, I can take this any direction you guys want to go. So a few reasons it's structured this way. If I was to go to the IRS and say, hey, I sell life insurance, that is my income, then the only write-offs I get are being a life insurance agent. License fees, maybe an event once in a while, maybe my office, but I can't write off, taking, I don't even know, an investor to a dinner. I can't write off, I can't think of anything like other things that a business consultant would do or a real estate professional would do. Here's the example I'm thinking of. I can't write off a rental property if my income and who I am as an insurance agent. And so to the IRS, I am paid a W-2 from my holding company. And what does this business do? It manages other businesses. It manages real estate flips. A real estate company manages insurance agents, me. It manages my wife's company. So it's a business consultant. Think about Warren Buffett. He owns Berkshire Hathaway, which owns a financial management company, an asset management company, an insurance company, all these different spinoffs. Because now he's the boss of this large corporation and he can do boss type activities and get those as write-offs. He's not getting only insurance person write-offs or only a real estate manager write-off. He's getting everything because he's involved and his main source of income is being this business professional. So that's why this setup is the same for me. This is who I'm getting paid from. I'm not getting paid from an insurance company. My business is. I'm not getting paid from a real estate deal. My business is. I'm getting paid from this. So that's who I am to the IRS. And then all my income, I want to flow into my policy. At this point, we have 3 policies. Going to be adding a 4th here next month. And then all my cash value in my policies, I take out and go buy rentals. So now let's go back to the example. These are the 4 pillars of real estate, why I like real estate. Now, this is not my policy, but it's one of my clients. This is an example of someone's policy. They basically said, all right, well, I want to deposit $150,000 into it to start. So we look here on the left side, the contract premium, $150,000 in year 1, and then $50,000 every year after that. And it slowly decreases over time. There's a lot of columns here, guys, so don't get hung up and study every number. I just want to focus on these 2 columns here. Look at the column that has the other underlined number, the column titled increase in net cash value. So in year number 1, he puts in 150 grand. His cash value increases by 132. Year number 2, the cash value increases by $47,000. And he put in 50. You get access to almost 100% of what he put in. So to me, in my head, I'm dumping in 50 grand of my extra income and I'm taking 47 out and I'm going buying 2 properties or 1 property. Year number 3, he puts in $50,000. The cash value increased by a new $50,600. So I had access to over 100% of what I just put in. I even made $600. Cool. Put 50 in, take 50 out, go buy another rental all day long. That's not going to stop my premium dollars from sitting with the insurance company and compounding. It's not going to stop the tax-free growth. It's not going to stop me from having a death benefit in case something happens to me. And I can still go buy my rentals and still get extra appreciation. So if we look long-term on this person's policy, when they're 8 years into it, they deposit $48,000 as a premium, and his cash value increases by $66,000. That's pretty freaking sweet. It increases by what? 40%, 140. You have access to 140% of what you just put in, 150%. It's pretty awesome. So I'm going to go put 48 in and take 66 out and go buy a rental, or go lend it to someone. I'll lend it to Drew, who's in here, who's going to do a real estate deal. I'll lend it, my 66 grand to him. He'll pay me 12% on my money. Now I have income in my policy and I have income from the lending. So let's show that example. If your policy grew by 66 grand and you put in 48, that grew by $18,000. That means your policy grew by 37%. You had access to 37% more than what you put in. Now, let's say you take the $66,000 out and go invest it with someone giving you 12% return. Now you have a 12% return on the private money lending deal. You have a 37% return inside your policy, and you owe interest to the insurance company on your loan of 5%. So your net income is 44% on your dollar. What did we do differently than the normal investor? We just put it through a policy first and let that policy accrue over time. So would you rather make just the 12%, lending it out to an investor, or make the 44% by putting it through a policy first? Duh, right? Run it through your policy first and then go do the investment. Be your own banker. That's why when you're looking long term, this just gets absolutely ridiculous. Look at year number 11. I wish I could highlight here. I can't. But if you look at year number 11, your premium is $17,000. Oh, I can highlight. Here we go. Yeah, there you go. You put in $17,000. The cash value increases by 45. Sweet. You just made 100% on your money. You just doubled your money, and you're going to go put this in a real estate deal, making you another 12%. That's much better than just taking your 17K you saved in that year and go make an investment and make 12%, right? That's why over time, these policies just get ridiculous. You want to store as much of your income every year into the policy and paying more and more premiums. So you're going to have more dollars sitting with the insurance company. You're going to have a bigger death benefit in case something was to happen to you. And then you have more money available to go take out and go buy rentals with. If this is your first time being here, guys, first time learning about infinite banking, this might make no sense. So I'd recommend probably watching just a beginner training on the concept. But those of you who know what I'm talking about, you get this. All we're doing is storing our money in the right places first, which is the policy. And then we're making the same investment decisions we're going to make anyways. I'm already going to go buy rentals. So might as well do it through a policy. I'm not changing what I'm investing in just because I put it through a policy. Nothing changes in your life when you add a policy. Only thing that changes is where your money is stored. Now, everything else is the same. Whenever you need to buy a car, a house, an investment, a debt, everything, you're going to do the exact same way. Just do it now through your policy. So coming back to you guys, we're 30 minutes in. I've been talking a lot. I'd love to get some more feedback and questions. We have the next 20 minutes for that. So I can hit any aspect of this further. I can give you any more thoughts or advice on this, but I'd love to just answer questions. So what do you guys think about the policy, the real estate investing, the entity structure and how you set that up, and how you run your money through your stuff? What questions do you guys have? Let's get into it. And we can talk about any of these in a deeper way. And if you guys have no questions, you're like, great, this is good content. Awesome. We're good for today. I'm cool to end early too. So I want to open this time up for you guys. John said, do you buy commercial properties? Yes. Right now, I think we have 4 apartments that we're currently rehabbing that we will eventually have tenants in them and occupy them. So yes, they're just a lot of work. And for me, so here's the thing. There's a difference between the income game and the wealth game. And being a business owner and not wanting to get my hands in everything. If I was to fix and flip apartment complexes and sell insurance and speak and learn a new language and work out every day and spend time with my family, I can't do all these things. I'm not Superman. None of us are. I only have a certain amount of time in every day. And so I'm going to spend my time on the things that make the most return. The return on attention, I like to call it, ROA. Not return on investment, but my attention, my time. What's the best return on my time? So if I want to teach people how to become wealthy and how to do these things we're talking about today, and that's my goal, that's my one thing I want to do, anything else that takes away my time from doing that, I don't want to spend as much time on. So if I'm going to buy a single family home that's already turnkey, I can just put a down payment on it, close it, have a property manager run it, and never look at it again. All day long, I'm going to do that. Doesn't take any of my time, doesn't affect my life. I can still focus on what I'm trying to focus on and keep building my business. But if I was to go and start doing these massive deals, that's going to take half my time. I can't do what I really want to do. It might make good money, but that's not what I'm here to do. I don't want to do that. I want to focus on my business that I'm loving and passionate about now. So it's all about how your time is spent, or at least for me, it is. Now, if I was to just buy a turnkey apartment complex, I think that's a great idea. And just have a property manager obviously run it. That works. But you need a lot of money to do that. And it takes a lot more due diligence. And I'm just not at the point where I want to do that right now. So I don't care to buy massive deals. I'm doing a couple right now because I have partners who are doing most of the work. But long answer to your question. That's my thought on commercial properties. Brad said, I'm still learning how to pay myself first, but I love what you're talking about. So I love that. That's the most important aspect. All these business books, any rich business owner, you read his book, he always talks about paying yourself first. You can't do infinite banking. You can't get policies. You can't invest unless you know how to save and budget. Like that's financial 101. So if you can learn how to put money aside, pay yourself every month, that should be the number one goal. Then if you can do that, now the question is, all right, well, how can I store these funds in the most efficient environments? And then how can I invest in the best things? Then those conversations come about. Then when you're making enough money, you're like, oh, well, now how can I pay less taxes? That becomes a question as well. Then maybe you might not be doing the best investment because you want to get the other investment that has better tax benefits. So it's kind of a game. You just keep learning and keep building. And every day I learn something new. Every day I hope to keep learning something new. So it just starts at square one of paying yourself first, learning how to put money aside, and then it only gets better. So a couple good questions here. What would you recommend for first-time real estate investors, your first deal, or someone who doesn't know anything? What or where is the best way to start with real estate? It depends on your time, depends on how much time you have. If you have, you work, let's say 4 days a week and you have 3 days off every week, I'd probably look into finding a way to increase your income. I would wholesale. I'd maybe fix and flip a small property just to get your feet wet, nothing too big or crazy or expensive, but something that you have a little more time on. If you don't have any time and you want to keep grinding in your business or your life, then I'd buy just a turnkey rental property. I would buy a property that's all turnkey means already in perfect condition, already rehabbed, ready to go. All you have to do is buy it and have someone live in it for you. So that requires the least amount of effort, least amount of money, least amount of work. All you have to do is save up some money, put a down payment on a house, and someone else manages it. So if that's what you can do that all day long. If you want to have a new income source and be actively in real estate, I would learn about wholesaling. I would maybe do a small fix and flip after you've done enough research and you understand what to do. And I'd be looking in the South. I'd be going to look in Florida, Alabama, Georgia, Texas, Ohio, maybe Indiana. I mean, all those states, I'd look in the big metros, in the big cities, Indianapolis. You can look even in Memphis, Atlanta, surrounding areas, Dallas, and Mobile, Alabama, Jacksonville, Tampa. All these bigger cities are great places, but they're all decently cheap compared to other places. A lot of homes I buy are in Alabama and Florida. I can buy a house for 80 grand all day long. I can flip it for 200 all day long. So those are some easier price points to get into. And there's banks that will lend you most of that anyways. There's banks that will give you 90% of the purchase and 100% of your rehab costs. You don't need much money down. You just need to know that neighborhood and make sure you have the right deal, but easy. And I say wholesaling also because you don't have to know real estate. You don't have to have money. You don't have to really have anything other than a property. Put a property under contract and sell that contract to someone else for 5 grand. Sell it to someone like me. If I want to fix and flip a house in Jacksonville and I'll buy a house at 80 and flip it for 200, I'll do that all day long. Your goal as a wholesaler is to go find me a house under 80 grand that I can fix and flip. And I'll pay you 5 grand for finding it. That's basically what a wholesaler is. They'll know a buyer who wants to buy something specific. They'll go out and find the house that fits into that. And then they sell it for 5, 10 grand to the investor. They make a little pop and then they go find another one for them. It's an easy way for you to learn the neighborhoods people like to buy in, learn how the numbers work, learn how to negotiate a deal and a contract. And then once you get a few deals, you're making extra income. And you could do that on the weekends too. You could be calling realtors every weekend. Hey, I'm an investor in the area. I'm looking for a house that is 80 to 100 grand. That's 1,000 to 1,500 square feet. It needs to be a little bit distressed. Needs to have some work I can put into it, and I'll buy anything in that area. Realtors will start coming at you with deals. They'll start sending you things they find, and if it works for an investor, go send it to them. Make a little pop on doing it. Make a little 5 grand pop on it, or $1,000 even. So wholesaling's very, very easy to get into it. Easy way to get into it. Wholesaling, maybe do a small fix and flip. And those are the states I'd look into. So great question. And sorry, I'm answering these questions long. So I hope these answers are making sense and not just rambling. Frank had a next question. He had a couple questions. He said, when you opened your first policy, did you first put all your loans in the policy? This way you can recapture the interest. So let me clarify, Frank. Do you mean like, hey, I had debts. I had some credit cards and a mortgage and car notes. And to start, the first thing I did with my policy was pay those debts off and pay myself back. Is that what you mean by when you opened your first policy, did you put all your loans in it? I assume that's what you're asking, but just confirm. When you opened your first policy, did you put all your loans into it? I mean, I guess I can answer that if that's the case. I personally was lucky enough to learn of this concept early in my life, early enough where I had no debt. So I didn't have any debt to put into it. I didn't do that. No. I treated my first policy as a savings account. My first policy, I just used it as a savings account. That's all. And when it built up to enough cash value for me to go buy a rental, that's the first thing I did. I just started using it for investments. Last year we paid taxes with it. We bought a car with it. So we can, I mean, now we're doing everything through it, but to start, I had no debt, luckily. And so I didn't have to put it through a policy. But most people who do start, that's how they use their first policy, is they run their extra money in to the policy, they take the cash value out and they pay down their debt, and then they pay themselves back. Very, very easy way to start learning the process, start learning how to pay yourself back. I think that's a great way to get into this. So if you do have debt, 100% get rid of it. Also, I wouldn't even start getting into real estate until you have that figured out, until you have a good budget, a good savings, emergency fund, your debt's mostly gone. I guess bad debt at least is gone. Then start saving and going to investing. If you have a 30-year mortgage, I'm not going to pay that off. I could care less. But if you have, 20% credit cards, I'm paying those things off right away. Yeah. So let me grab my charger. So it depends on your debt, if you even want to do that or not. But I would say that would be the plan, is just get rid of that debt, get rid of the dollars you're paying to other people, start paying yourself, start saving more, and then get into investing. All right, guys, I'm going to wrap it up unless you got any more questions. If you guys want to learn about real estate, if you guys want to learn about more about policies, how to incorporate the two, I would say, obviously, you could reach out to us. If you want to email me and ask me a few questions, go ahead. I'm throwing an email in the chat right now. Email me your questions. We can chat, even set up time to meet. But if you want to just learn about this more, go follow me on Instagram or Facebook or TikTok. I post a lot of little videos talking about how I'm using my policies, what I'm doing. And I just threw in the chat my Instagram and everything, all the socials, my handle, Carson.Herleen. Just look me up on any platform. I post a lot of stuff about it. And I'd love for you guys to, be a part of what I'm doing in my journey. I'd love to see your comments on my posts. I'll reach out to you guys. I'd love to even share your guys' stories on my account. So feel free to reach out to me via social media or my email, and we can chat with whatever you guys want to chat about, any questions you have. All right. Well, every Thursday, Jason does this webinar. Chris Noggle does a webinar every day. If you want to keep being around our campfire, our group, please do. Please come back and keep learning. We talk about new things all the time. So thank you guys for being here, and we'll talk soon.